Assalamu alaikum, everyone. So it's 9, that is the given time. So let's start our session today. My name is Muhammad A Azeemi. I'm the founder of Mastering FRM, which is a service preparation provider of FRM certification from Global Association of Risk Professionals. Um, so today's topic is credit risk modeling under IFRS 9. And we are so honored to have Hammad Azeemi, who will be sharing his thoughts and his experience. Just to give you a brief profile, Hammad has been working with EY Middle East for last few years. Before that, he has been working with PwC Pakistan. He'll be telling him about himself, but Hammad, thank you so much for your time and for joining us today. So to start with, if you could give us a little background, what have you been doing? How has been your experience? And what are the things that you are doing right now? Over to you, Hamad.
Okay, thank you, Wes. Thank you is have here. Assalamu alaikum and hello everyone. My name is Hammad A Azeemi, and currently I'm working as a manager in EY Middle East. Okay, in a FS practice, mainly involved in the engagement and assignments related to the IFRS 9 ECL models review, validation, and enhancement, mainly covering the large banks within the GCC region to ensure their compliance with the IFRS 9 standard, regulators' guidelines, and the industry leading practice. Uh, I have gotten I get like more than a decade experience in the development of credit rating models, validations of those models, and suggested the enhancement. And that's the reason why today I'm here to share my thoughts on the topic of IFRS 9 modeling, ECL modeling. Before joining EY, I worked for HBL Pakistan and PwC member firm, that is Air Ferguson. Some people know with that name in Pakistan. And from the academic side, I'm a certified uh, uh, FRM, Financial Risk Manager, with the base degree in Actual Science and Risk uh, Management, along with the Masters in Economics. Uh, just want to highlight and just want to mention one thing, because here the people are joined this webinar around the globe. So any opinion or any point which I'm going to discuss here or shared during this session or any other session, uh, it should not be treated as a some opinion which would be representing my employer or anything. It is my personal opinion about this topic. So that's just a brief overview of my experience and expertise.
Thank you, Hamad. And you highlighted a very important point. This is something that will be followed throughout the process, because this is a guest speaker session that we have initiated, and we are going to have multiple speakers. So this is a standard policy that we'll be keeping, because obviously professionals will be coming from all around the world. So and we know all the liabilities things. So we will make sure that and that's why we put a dedicated disclaimer in our flyer, if you have noticed that, and if all of the participants that are joining us today have noticed. So and I think that's everyone understand that, but thank you so much for joining us today, and it would be an honor to hear to you today. So to start with, give us an idea. So basically the topic that I picked it for IFRS 9 as our first session is because I have been getting a lot of queries that they want some resource regarding IFRS 9 in Pakistan. And let me tell you very honestly, I have been putting the post on LinkedIn and assisting people finding IFRS 9 resources in Pakistan, and there aren't many. I hardly came up with people who have a relevant experience of IFRS 9, especially in the modeling side. So people know about IFRS 9, they have been working on it, but when you go to the market and when you know you go there and you search for relevant people, you hardly find someone. And obviously, you must know that Pakistan is in implementation stage of IFRS 9. We are far behind than the Middle East and the other region. Having said that, tell us why IFRS 9 is, and so we have basically different kind of people. Some are already working on IFRS 9, and some people like me who are still learning about IFRS 9. So, if you could just give a brief idea what, and in simple words, without any technical, details. I know it's a technical subject and would be difficult for you to explain it non-technically, but if you could just talk about what IFRS 9 is, what was it about, why they needed an other IFRS 9, another standard to come up with. So if you could just keep it very basic and at a basic level explain what IFRS 9 and what how do we go about it.
Okay, so as you rightly mentioned that this is the hot topic, and to be honest, within more than a decade experience in the quantitative and in the credit risk modeling field, to be honest, in my opinion, this is the most evolving topic, which evolves so quickly that there's no general rule of thumb which you can apply on the IFRS 9 modeling. And to be honest, uh, it is an unfair, and it would be unfair to cover IFRS 9 or either the conceptual side or the modeling side in a 1 hour session. So I would suggest that going forward, if in my humble opinion, if there is any possibility, if you can just schedule 2 or 3 more sessions, which would cover the technical aspects of IFRS 9 risk parameters regarding the PD, LGD, EAD, staging, uh, SICR criteria, macroeconomic overlay, management overlay overrides. However, as you mentioned, I'll try my best to give an overview for to keeping in mind all uh, the people or the participant, whether they are from the financial institutions, non-financial institutions, or they are at the what you can say at the beginner level of the IFRS 9, or whether they have seen the implementation of IFRS 9. So I'll try to uh, cover all the angles. So
Hamad,
just
Hamad, before you go there, sorry for interrupting, but as you mentioned that it is a vast topic, so would it be possible for you to take a further more couple of hours in next few weeks and conduct 2, 3 more sessions on IFRS 9 and enlighten and teach us more about the modeling side and somewhat not advanced, but somewhat a bit more advanced level, if you would be willing to do that and have that time available with you.
uh, sure, Wes. I think so. We can do that. For that, I have to check my calendar. And secondly, because if I have to go on to the technical sides, then I have to work upon to prepare something so that I walk the audience through the PPT and all the technical, some practical examples. So yeah, we can do that. We can plan accordingly. That's not an issue. I would be uh, really willing to spread the concept around the IFRS 9.
Thank you so much, Ahmad. I think people would love it, and you can take your time. Nothing, no, like I'm not saying that you just tell us right now. You can just confirm later, and we can, just float it in the circle, and we can have a couple of more sessions. But today's session is it's more like journal, so we will just go through the basics of IFRS 9. Coming back to the question, you had to explain what IFRS 9 in simpler words, if you would be able to do that.
Okay. So, like in IFRS 9, there are three areas which comes under the this standard when this standard uh, circulated by the IFRS body. One is regarding the classification and measurement of the financial instrument. One is regarding the impairment of the uh, instruments, and one is regarding the hedging. So my area of expertise is related to the impairment side. So I would be covering the impairment part of the uh, IFRS 9, which is around the ECL modeling. So just in brief and quick overview about the IFRS model, that this IFRS 9 standard substitute the incurred loss model approach that comes under the IS 39 with the expected loss model approach. So when I said the expected credit loss models, the expected credit losses are to be recognized all times in the forward-looking approach, because the word expected somehow indicates towards the forward-looking approach that reflects the changes in the credit risk of the financial instruments. So what's the difference between the IS 39 and IFRS 9? That the IS 39 is a kind of a backward looking approach that based on the loss incurred in particular reporting or specific period, and then on the basis of that we calculate the provision, or what you can say the loss amount on the basis of incurred event. However, in the IFRS 9 impairment approach, it's a more of a forward looking, and that's the why we using the term expected credit loss, where we calculate the provisions based on the expectation of the losses. So in that IFRS 9 standard, there are some different uh, mechanism, three-stage mechanism, and all other things, which we will discuss in detail going forward.
Okay, so what I understood from your explanation is the last standard was more of a backward looking, like it used to use history, and IFRS 9 is trying to focus on the forward looking to be able to make predictable projections about the future and make it more realistic.
Yeah, the reason is very simple, Wes, because during the time of, if we talk about the financial crunch downs and other financial crisis, which occurred in the past, at that time there's no concept about the forward looking information or to incorporate the forward looking information in the past. So what happened that we build model on the past and we think that the history would repeat itself, and that's the reason why if we go about the black swan theory or any other extreme value theory, it talks about that there occurs there are chances of occurring what you can the high severity events, but you can't model or you can't predict them because their frequency is very low, but the loss or the severity they hit on your books or on your asset, that is very high. So that's the reason why that the body, the regulators, or you can say the prudential bodies or the regulatory bodies, think that there needs to be revision of something, and they come up with this IFRS 9 standard.
Okay, Hama, thank you. I got it. I got it. So now tell us about applicability of IFRS 9. So what I have heard of mostly that it has been talked in the financial institutions, mainly in the banks and the DFIs. So there had been more talk about in that particular front. So is it applicable to banks only, or is it applicable to non-banks only? And what is the difference if it's applicable to non-bank organization also? Then what is the difference between the two approach? Are there any different approaches? So what is the applicability, if you could just tell about it?
So, regarding the applicability of the IFRS 9 standard, so wherever there is a financial instrument exists, you can apply it. Okay, because the standard itself say the IFRS 9 financial instrument. So there are two approaches defined. Uh, the main two approaches defined under the IFRS 9 is the one is the simplified approach and one is the general approach. So simplified approach talks about the trade receivables, contract assets, leases receivables, and usually it applies to the non-financial institutions where they don't have any, what you can say, the financing concept. They have their businesses revolve or more around the receivables, assets, or these kind of things. So the simplified approach allow entities to estimate the expected losses on all their assets without the need of any increase in any credit risk because they have the receivables with them. On the other side, there's a journal approach in which we have to, which is mainly applied on the financial institutions, where we have to see a loss allowances and the lifetime expected credit losses in financial instruments, where the credit risk of the borrower and customer can be increased. So, in other words, uh, the journal approach is more applicable on the financial institution sides, and the simplified approach is used generally for the uh, non-financial institutions. And there are different multiple approaches under each of the approach which could be used for the calculation purposes.
Okay, so basically, it's applicable for both the banking and non-banking institutions, but the approaches vary. It's simpler for the banking institute, for the non-banking institute, and it's somewhat more complicated for the banking institutes. If you could just highlight uh, how is this relation between, as I've been working on Basel II for quite some time. So, is there any relationship between the Basel II credit risk approaches where we use to calculate the probability of default, the exposure at default, and the loss given default? Is there any relation to that particular modeling that bank had been doing, or is this something that is completely different from Basel II advanced approaches?
So, Ovas, that is a very valid and good question, but for the time being, I park this question, and when I'll go into the details regarding the what is the difference between the Basel and the IFRS 9 approaches, I will address your this question over there. However, uh, Basel models or the concept the Basel introduced about the expected credit loss, somehow the same equation has been used for the ECL calculation purposes. That is probability of default times the loss given default times the exposure or the outstanding into the discounting factor if there is any. So the main concept of the ECL calculation or the expected credit uh, loss is around the Basel equation, but there is some minor things which I'll address later on. Before that, going into that detail, I just want to explain that what the standard actually says about the definition that how you should or any entity should calculate the ECL and what should be reflected in that. So the standard talks about three things. Okay, one is that I'm not just quoting the standard. I'm just referring that what it infer. So first thing, the standard said that your estimate should be unbiased and probability weighted. So that it should be come up with the multiple scenarios. It shouldn't be like this that I just use one scenario and take the result from that. Second, the standard talks about that you should incorporate the time value of the money. And the third and the most important thing is regarding the reasonability and the supportable information which is available to the institution or entity about the past events, current condition, and the future economic forecast without any undue cost or effort. So it is not something like that we have to go and implement that particular thing by hooks and crooks. It's not like that. It is that there should be a proper cost benefit analysis in place where you can analyze that whether is it making sense to invest that much amount to do anything or not. That's the reason why that in the this part of the world, initially the banks implemented a very basic models. They didn't go for the sophisticated models or regression based model. They use very basic generic model which can meet the regulatory or standard minimum requirement. Now, in this part of the world, the institutions are building the second generation or third generation model where they start collecting the data for the last 3 years. Now they have data warehouses in place where they are using crunching data and coming up with the models. So there's no, what you can say, one rule of thumb which should be applied. And there's a one very good paper around the uh, IFRS 9, which is the GPPC guidelines. Okay, it is easily available on the website. It's like big 6 firms consult together and issue that paper. That paper also talks about the two things. The main 2 point is, first is around the governance, that how you how good data you have, what systems are in place, how you can extract the data, whether that data can be used, what is the quality of data. And the second thing is regarding the reasonability and sophistication of the models, whether you can use it and build a proper model or not. If not, then park it for time being and use it for the some later stages when you have ample data to create. Because if your data is garbage, your result would be garbage. It's a gigo concept, garbage in, garbage out. So your data quality should be very good if you are going to build model based on internal data. So this is the one thing. Now, then if we go on the other side where you talk about the that how the Basel models and Basel PDs are different. So Basel, many banks where the Basel models are in place, they leverage those models to get compliant with the IFRS 9 standard. But it's not like that, that just pick and use those models. They have to do some adjustment. Like in the IFRS 9 uh, thing, there is a requirement to make your information point in time. Okay, so they have to do some adjustment with their models, their PD models, because the PD model in the Basel, it talks the through the cycle approach, which is around only talking about the individual risk. It doesn't talk about the systematic risk. But when you apply the point in time implementation, or you make your PDs or your parameters point in time, what you are doing, that you are covering the systematic risk as well, and you are accounting for the current information as well. So this is the difference between the Basel and the IFRS 9 approach. However, many banks in this region or in this part of the world use or leverage, or even in the developed part of the world, they use the Basel compliant, IRB compliant models for the IFRS 9 calculation purposes. So again, coming back to the IFRS 9 part, the IFRS 9 impairment revolves around the three-stage approach. Uh, Stage one is around the mm, no significance increase in credit risk. And for that particular stage, we have to calculate a 12-month ECL. There's a two other stages that is called the second stage, usually named as a significant increase in credit risk. And there's a third stage, which is credit impaired, or you can say that some stage which deals with the defaulted customers. So for third stage, there are different approaches to apply. Uh, but for the second approach, stage two, for second stage, the bank usually have to calculate the lifetime ECL. So they have to see that how to deal with it.
And Hamad, sorry to cut you off, but I hope that you'll be able to talk about these things in more detail, because you have been using a lot of terms, the point in time and the through the cycle, and am lost. And I'm pretty sure that the participant who are joining for the first time would also be lost. So I would really appreciate if you. I understand you have been explaining and something very technical, but I would appreciate if you can keep this in mind and cover it in a more detail with some, some presentation or something, so people may have some more idea about these concepts. So I know these are technical concepts, but that is something that I really appreciate. So thank you so much. You have explained it very well, I think. So one clarity, when you are saying in this part of world, what do you mean? Do you mean Middle Eastern market, or the Gulf market only, or the Pakistani market? If you could just clarify it a little.
Okay, so because I'm based in Gulf, and my like for IFRS 9 related, my mainly experiences in the GCC region. So I'm talking about the GCC region as well as the UK and Europe side as well. So so in Pakistan, what my understanding is that banks are currently working on their models, and they are also taking support from different vendors who are supporting them in the ECL computation and ECL calculation. Uh, and I think so. State Bank of Pakistan has issued some guidelines that the banks have to be compliant. I think so by the end of this year on the IFRS 9 uh, or not. I'm not sure about that, but I heard that there are some circular issued by the State Bank regarding this.
Yes, I think so. It was supposed to be implemented earlier, but due to COVID-19, they have pushed the deadline. It has start core non-banking has started giving results, but banks are still in process of model development and all. So they have conducted the impact study already, but they are still in phase of development. Okay, so one question that I have, you talk about data and data availability. So there's a question by, I think, by Muzaffar, who is asking that please also brief about the data requirement and challenges related to data. So if you could just mention what sort of data do we require for IFRS 9 modeling, and what challenges did you face while building the model in Middle East and the Gulf, the regions that you have been working.
Okay, so Wes, what I'll do that I'll park that question for time being. Uh, First, I just want to give a quick run on the parameters, that what each parameter talks about, and what are the components which uh, involve or play a major role in the ECL computation. And then I think so for the last 20, 25, 15 to 20 minutes, we can spare for the Q&A session. Would that be fine? Meanwhile, all the participants can either park their question or put in the chat box, so that once we are near to the Q&A session, we can answer their questions.
All right. Sure. Sure.
Okay. So coming back and coming again to my initial point, that I already talked about the three stages which are involved or which needs to be categorized. These stagings are on the basis of what you can say on the increase in the credit risk of a customer or an asset. Okay, so there are certain criteria on which the banks or the institutions defined that for their portfolio or their organization, what is going to be that trigger point on which they will shift their customer from stage 1 to stage 2. If I give a very basic example, that when we for the capital requirement, if I go to the old Basel standardized approach time, there's a one is investment grade and the other is the non-investment grade. So usually the risk weight assigned to the investment grades are low, and for the non-investment grades, the risk weights are high. So same applies to the stage 1 and stage 2 criteria, that what you have to do, that on the certain triggers, it could be either qualitative, quantitative, depending upon the size of the organization, their portfolio mix, or the industry or the regulatory requirement, because you can't only be compliant with the IFRS 9 standard. You also have to be compliant with the regulatory requirement, that what your regulator is saying, that what needs to be done. So there are certain criteria which could be used. Like if I give a very basic example, so any downgrades in the corporate rating could be considered a one criteria for significant increase, or for retail or consumer customer, if any your customer is going to hit the DPD bucket 2. So when I say DPD bucket 2, that is payment is due more than 30 days. So it is a trigger that, look, uh, Mr. Hammad has not paid his credit card bill and it's due for the last 30 days from the due date. So there's some chance that he has some financial issues. So they might move me to the uh, stage 2. So on the basis of staging, there are certain other things defined, that whether we are going to calculate a 12-month ECL or the lifetime ECL. So if the customer is residing in the stage 1, then we have to calculate a 12-month ECL. And if a customer moves to the stage 2, then we have to calculate a lifetime ECL. To calculate the ECL, the equation as earlier mentioned is very simple: PD into LGD into EAD. So the EAD is the component which remains same. Now, the most technical part in the IFRS 9 is always around the PD and LGD. So for PD, there are so many approaches. So due to the time constraint, I cannot go into the details. But if we have to calculate a PD ECL for 12 months, then we have to use a 12-month PD. And when I saying 12-month PD, it should be point in time PD. Okay. So what is the difference between the point in time and the through in cycle? That usually the through the cycle or the Basel PDs or the average PDs is usually not correlated with the economic cycle, is usually a PD and LGDs are on the longer time horizon, that either we are taking an average of 5 years, 6 years, or 5 to 7 years data, and on that basis, we are calculating the PD. So it only covering the individual risk. Okay. So the systematic risk part is not covered in the this particular PD, which is coming through the Basel and all the things. Because if you look at the Basel model construct, it not talks about the economic cycle. We are not looking at the future macroeconomic outlook or anything. So then there are certain approaches, certain methods which we use to make your PD point in time. Okay. You use those approaches, those methods, apply those techniques according to your portfolio to make the PDs point in time. Then there are certain approaches that you have a PD for 12 months. Okay, usually we have a uh, probability of default for customer for a particular time period. Now, the one good part of the IFRS 9 is that it introduced a provisioning calculation for the entire maturity of the loan, entire life cycle of the loan. So let's say if any customer, if uh, any corporate customer whose loan is, the maturity of the loan is 3 years and it resides in the stage 2, so we have to calculate the lifetime ECL, and the word and the terminology itself explains the lifetime means that throughout the life of that loan, we have to see that how much there are, how much loss we can expect from this customer for the entire 3 years. But customer who reside in stage 1, we calculate 12-month PD, because as per his credibility, we uh, we determine that this customer, there are only chances of 1 year that this customer is going to be in credit loss. Other than that, his credit uh, profile, credit behavior, payment behavior is not reflecting that thing, that we should park or reside that customer in a stage 2. So same goes for the LGD. For LGD, there are I have seen multiple uh, methods and approaches to calculate the LGD, and where the institutions don't have the data or information to calculate the LGD, because LGD is something which is result which is derived through the defaulted accounts, because we have to see that how much amount we can recover from the defaulted, and after that we will calculate the LGD, because it's a 1 minus recovery rate. Okay, so we calculate LGD on that basis. Institutions where the LGD is not available, or they have some data issues, because pre IFRS 9 standard, some banks, I know some banks didn't record or keep the recovery data in a very good manner. They just keep it in a core banking system where they just simply make a debit credit entry, how much recovery has come, and that. So they can leverage for ECL calculation purpose. Regulators allowed them to use the Basel LGD, that is 45%. So initially, at the time of implementation, like in 2018-19, some big banks uh, around the globe use the regulatory LGD. Okay, but now during that course, they start collecting the data. Now they build their own models, and they are using their own LGD, which is for many of banks, which is too low as compared, or very low as compared to the Basel prescribed LGD. So on the basis of that, we calculate the ECL. There's one major aspect I just want to cover it quickly is about the macroeconomic uh, condition, or use the macroeconomic overlay, because as per the standard deviation, you have to cater all the things like your past, your current, and your future macroeconomic forecast. So we have to incorporate the macroeconomic outlook into our models. Okay. And again, there are different approaches on which you can build the macroeconomic model. There, it could be regression based model if you have enough data points. It could be Waseychuk model. The selection of the variable can revolve around so many things. It could be business intuition. It could be the proper single factor and multi-factor statistical technique where you can see the uh, relationship between the institution or the bank's default rate with the macroeconomic variable, and that could be done. So there are, like, it's a whole universe. And to be honest, like, I'm working on the FRS model in this region for last more than 2 years, and still I'm learning, because every it's a like most evolving topic I have ever seen in the quantitative side, that it evolves on the daily basis. And one last thing, which I just want to cover very quick regarding this current COVID scenario. Okay, because uh, this is again one-off event. It won't occur on a regular basis. Okay, so regulators bodies are thinking about it, because to be honest, it is very difficult at this point in time to incorporate the special effects of COVID-19 into your models. The relaxation and the holiday period payments are the deferred payment plan or supports given by the central bank or the government to the customers. However, the change in macro or the economic condition could be, or what you can say, should be reflected in the macroeconomic scenarios when you are applying these scenarios. So you don't have to update your models, because somehow it is an outlier, and when I incorporate any outlier in the model, it would uh, maybe backfire. My model will backfire. It won't give me a good result. But some kind of a business judgment, management, intuition, and post model overlay or adjustment could be done. However, nevertheless, many regulators have issued guidance all around the globe that how you are going to deal with this situation, what sort of steps or application needs to be done on your IFRS 9 in the current environment, and how and if any changes need to be done in the model, what is the right time and when it needs to be done. So there's a lot of debate is going around the globe by IASB, European Banking Authority, Basel, and the local regulator as well. So that's I tried my
Hamad,
best
I think your
I
video has stuck. Okay, it's fine.
is it fine
No,
now?
I think that was very informative. So what I have understood from, yeah, it's fine now. So what I have understood from your point is we have mainly three points to be taken care of in the IFRS 9.
What's that thing?
So the first thing is the probability of default modeling that has different approach and regulatory number. Yeah, can you hear me now? Yes, am I audible now? Okay, right. So can you hear me now, Hamad and others? If you could just confirm in the chat box that uh, yes, okay, all right. So I think there was some background noise. So what I understand from your point is we have mainly 3 points to be taken care of in the IFRS 9 broadly from a modeling perspective. The first one is a probability of default modeling, which is somewhat related to what we used to do in the Basel 2 with different parameters and with different models. Second thing is that we used to have LGD number from the regulator, which was 45%, but banks are required to do LGD modeling also. And the major challenge there is to have the recovery rates and to have the data available for the LGD modeling. And the third one is the macroeconomic indicators, where we want to make our model forward looking, past looking, current looking, and forward looking. So we will have to adopt all these numbers.
Okay. Yeah. Well, it's very finely covered by or described by you. Just want to add one thing, two things over here. First thing, it's not necessary to always use the Basel model, Basel based or IRB based model for PD. You can use simple transition based approach or Markov chain based approach models, or you can use a simple scorecard or rating grade. So it's not mandatory requirement. If you like banks, whether they had those models, they leverage use to those models for the ECL calculation purpose. Regarding one element I missed is one more modeling aspect is around the CCF, is the credit conversion factors, which comes in action around the revolving facilities. Okay, because for revolving facilities, like if I talk about the credit card, a very easy example, that you have a particular limit, and it's not necessary that when I'm calculating your ECL, you have used the maximum of your limit. Maybe at that time only 10,000 PKR is outstanding. So there's a one impact in the revolving uh, facilities or the revolving criteria where we have to model the CCF to see that how much outstanding or EAD should be, how the EAD should be calculated for that particular facility. So that is one aspect in the EAD side. Other than that, usually where the payments are bullet or in the installment structure or the non-revolving facility, it's remains same. But for the other part, for the revolving, there's a one more modeling concept, and one is the more one another key element in the IFRS 9 is around the effective interest rate. Sometimes the bank use the contractual profit rate or contractual rate for the ECL calculation purposes, because you have to discount your cash flows to come at the particular time period. So it varies. Some banks are using DIR, some are using the contractual contract rate based on the some representative analysis. So, but it has nothing to do with the modeling side.
Okay, so one related question, I think someone also asked it that how the provisioning requirement change after ECL implementation. So did bank require to uh, increase their provisioning by substantial significant numbers after the implementation of IFRS 9, or is it actually decline after the implementation? Because I saw that there was some adjustment in the provisioning after banks implemented the IFRS 9 models.
Okay, so to be honest, it depends upon the local regulatory requirement. Okay, that what your regulator is saying that, I if I recall it correctly, that uh, at the time of initial uh, stages or the first time of the adoption of the IFRS 9, in the many jurisdiction, the regulator asked them that, okay, calculate your provision as per the IS 39, which is 25, 50, 100. Okay, calculate your provision as per the ECL. If the number is coming higher by the IS 39, create or make it as a reserve, park in your books as a impairment or provision reserve, or later on, because IFRS 9 implementation is first time. So you create that reserve, but in your books, mention or record the reserve coming as per the IFRS 9. So there are different treatment which regulator has given, and you have to manage according to the regulatory requirement, that what they are saying. But sometimes they said manage the higher of one. If let's say IFRS 9 provision is coming higher, record that, no need to create a reserve. If CBUE provision is coming higher, IFRS 9 is coming low, in the financial statement, disclose that. Take the management overlay, because there's a one concept of management overlay which I cannot touch at this point in time due to the time constraint. But let's say X amount is coming from the IFRS 9, Y amount is coming from the any central bank requirement. The difference between X and Y, we can take it as a management overlay. We can add that in X and record the IFRS 9 that is here. So there are so many what you can say practice around the globe. So there is no what you can say one standard answer, but it depends as per the regulatory requirement.
Okay, so that depends on what regulatory requirements are, and that requirement will definitely different in Pakistan, and that would be different for the UAE and in the Turkey. So since we haven't implemented it, so we cannot be sure about it. So there is one another question. I think we have 10 minutes left, so we'll be taking a couple of more questions. So there's this model that if ECL model is focused more on the future data, then how reliable we can consider the past data? Uh,
Okay. Uh, so uh, to answer this question, it's not about the focused on more on the future data. It's what that we are incorporating the impact of a future outlook into our current and the previous behavior of a customer. Because how you determine, like usually around the globe, there's a concept of a bureau. What bureau what bureau does? They maintain the customer profile, and on the basis of that, they provide a certain rating of that particular customer. And on the basis of that behavior, you decide whether I have to give a loan to that customer or not. So it's not that we only focusing on the future. What we are doing, because we are talking about the future. Now we are expecting something to happen in the future. So that's why we are incorporating the future macroeconomic scenario into our ECL calculation. I hope I'll answer
Yes,
the
I
question.
think you're clear. Another question is that someone asked is if will it have some impact on the capital adequacy ratio on the car of the bank, or will it remain, unchanged? And how that impact would be translated into car? I think it will go through provisioning. If provisioning will increase, that will be deducting from the equity.
Okay, so there are some accounting treatments, some different treatments are going on, because if my provision is increased, my provision will be deducted from the my PNL. Okay, so my PNL will be get reduced. So that in that sense, yes, there would be some impact on the your uh, car number, but it could be on the both side. You can't say that, because the car is coming through your risky weighted assets, which is the standardized approach, that how risky your assets are against your eligible capital. So there might be some indirect impact, but not the direct impact.
Okay, all right. So there's another question by Adil who is asking that what will be the impact on stage one and stage two provision on credit risk weighted assets? As we are including this in tier two capital, it means we will not take any impact on stage one and two ECL in credit risk weighted assets. So it
So
will it
so
have some impact on the stage one and stage two provisioning? Like, I think what I'm understanding from the question is we used to have doubtful and these classifications. So has it been entirely replaced by stage one, stage two, stage three? And would it be reflected of the initial classification, or would it be remain same?
okay, so I think so. The other question is, if I understand it correctly, because stage one and stage two has nothing to do with the CRWA. So, if I understand correctly, it is more around the disclosure requirement, that how it is going to be disclosed in the financial. So, if I understand it correctly, uh, so the disclosure requirement is driven by the regulator, that how does a regulator want to be disclosed in the financial statement. So uh, if Adil question is around those lines, so that would be if it's for the Pakistan, that the State Bank of Pakistan will disclose that how it is going to be impact. And if uh, it's around the stage one and stage two ECL, that it is going to be replaced, like going forward, it would be replaced the uh, substandard doubtful loss category. So yes, going forward, what I have seen so far in the disclosure, that it would be replaced by the uh, these three stages.
Okay, all right. So I think we have
I
pretty
hope
much.
I hope I have answered the Adil question. If still some clarification is required, Adil, you can write in the chat box.
Okay, so I think we have pretty much covered a lot today, and I'll have to go to a walk to digest it, all these technical things. But I think it was very fruitful session, Hamad. Thank you so much for sharing all this information. But having said that, as you very critically highlighted, that it cannot just be covered in one session. So I think I'll be getting in touch with you, and we'll be taking some more hours of yours, and we will try to do some presentation based, in which maybe you can cover PD modeling and LGD modeling in one session, and the macroeconomy in one section. So it depends on you how you really want to cover it. But it would be an honor, it would be a pleasure to have you again on board, and to be able to go more into detail, and to be able to know the technical side of these aspects also. So I think, is there anyone with further questions?
If anyone want to discuss anything, he or she can mute uh, himself or
Yeah, you
herself.
can just unmute and ask also if you want. Okay, so how IFRS 9 can be worked on in equity instruments or impairment of shares, investment in shares?
Uh, so, uh, so regarding the investment and the shares, usually what I have seen so far that they don't have any internal uh, default history or default pattern. So, as in globally, what we do that we have to stick with the external rating for the sovereigns and the investment. And by using the sovereign rating and investment, we use the PDs according to that rating, either by S&P, Fitch, Moody's, whatever is available. Then some institutions transform it to make it to point in time because that is 20-year or 20 more than 20 years average PD, which Moody's and other data warehouses is computing. So we make it forward looking, and the rest of the process will remain same. The EAT would be coming from the investment and the sovereign side. LGD, we have to stick to the regulatory one, or maybe it's Moody's has one publication where they usually disclosed the LGD for the sovereign and investments, bonds and other things, but that is a paid subscription, so usually don't available publicly. Mainly banks stick with the regulatory LGD for investments, and that's how they calculate the ECL.
So basically, there's a concept of internal credit rating and external credit rating. This is something that I'll be covering in my videos also when I've already launched my YouTube channel. I have shared the link of it, so you can just subscribe in this video. Some part of it will be available on the YouTube channel also, and I have also shared my LinkedIn profile. So if any one of you doesn't follow me, they can follow me, and I have shared the link of Hammad's profile also. So you can share him as add him as well, and we keep sharing our information. So I think we should be signing off from here. We will have a couple of more sessions of IFRS 9 modeling. So we understand that we haven't covered and we haven't gone into detail in of IFRS 9 modeling. So our title was IFRS 9 modeling, but we have stick to the basics. So to be able to make ground so that we are on the same level. So since we have covered the basics uh, of so we have covered the basics of IFRS 9. I think we will be able to cover more about the session, the coming session. All the link will be shared on my profile, and we will also be able to email you to the ones who have shared. So I think thank you so much. Thank you to everyone for joining in, and I'll be able to share my detail about the link. So Hammad's session will go on, but we have another session planned of role of artificial intelligence in risk management with Badr Munir next week on next Wednesday. So we will be having that session, and Hammad's session would probably on either Monday or either on probably on Friday. I'll let
Yeah.
you know about that.
Yeah. And one
as
thing,
we come up with the
yeah,
time.
and if anyone has a specific query or something they want to discuss, they can reach me out over LinkedIn. So I'll try my best that on the basis of my experience, I'll help you guys and try to answer your query.
Thank you, Hamad. Thank you so much. Thank you for your time. We'll be seeing you soon, hopefully, on another session, inshallah. Thank you. And thank
Right.
you so much for joining in and taking your time out. We have people joining from Malaysia and UAE and Oman. So we have a good global coverage, alhamdulillah. So we hope to continue it. We'll be coming up with such more sessions, inshallah. So looking forward to it. Thank you, Hamad, and thank you everyone for joining in.
Thank you,
Thank
everyone.
you. Good night.
Thanks a lot. Thanks a lot. It was a really nice session. Take care. Allah Hafiz.
Good night. Take care.